Well, we reach a key support on the S&P 500. Is it the bottom? Okay, looking at the level of VIX, which is the measure of fears, basically, we can see that all the measures which have been called emergency measures have not really reduced the amount of fear in the last 2 weeks. We still have higher highs, and it closed on the 16th of March above 75% or close to 80%. So it is a very emotional period. We still have the VIX levels here in the dotted line, and we noticed that the yield on the 10-year bonds in the US, having hit 5%, has been rebounded a little bit. We would like to try to look at the short term since the first week of March and 31.20, about that levels. And we could see a move down, a pullback, a second move down, second pullback, and a third move lower. And there is some chance along this bullish divergence here that there will be some rebound. You see here the VIX on orange, dotted line is moving to higher highs and higher lows. The green line, the 10 years, is trying to make a bottom. That's possible for the next 3 weeks, and that would call for a kind of a rebound up to mid of April. Here, if we take a more longer-term view, we notice that this rebound that we expected toward 2,700 from the 2,350, which is the key support level of December 2018, could extend to 2,900 at maximum. Then there probably will be some pullback. And the big question is, do we continue on the right path, all the way breaking 2,350 toward 2,100 and 2,000, which are the support levels of the year 2016? That's possible. It will depend how much luck or bad luck we've got with this virus. But we could also envision the switch to a green path if we are lucky and if things get a little bit better and if things have been, or the bad scenarios has been too much anticipated in the price. So it's relatively open. Now we are really at a key level of 2,350, trying to look at what could happen. We need to notice on the sector side, within the US market, which are the 3 sectors which are the best, which have been doing the best relative performance. For that, we use the orange dotted line here on the top, which is showing the ratio of staples sectors versus the S&P 500. And we see here clearly higher highs and higher lows on this orange dotted line, despite the nominal breakdown all the way to March 16 here. The second sector, which is going to give us some comfort, if you wish, during this debacle, is the healthcare sector, whose orange dotted line also is rising during this big decline. Okay, we see here. But we notice also the black line, which is the relative strength of biotechnology versus healthcare, which is coming down and taking a big hit. So not all sector of healthcare, probably it's pharmaceutical, which is doing well. So that's the second sector. And the third sector is obviously, well, the technology sector. It remains, despite all this big decline, from 102 to 71, a rising ratio, a relative strength line, orange here, is still making higher highs. And the old leader is probably going to be the coming leaders also in the rebound. So we noticed, therefore, that possibly most money managers, which have been taking a defensive attitude, have been selling the other sectors, especially energy, as we all hear about it, but also trying to go into defensive sector, staples, and they have probably not sold massively yet the good leading stocks that they had in the technology sector, which is relatively a good sign. So the whole message of today is we hope the 2350 on the S&P 500 would hold today. We would be happy to have a rebound above 2530. And we would like it to develop over the next 2 weeks. But still, the message is a caution one, and we thank you for your attention.